Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the Deal Quest podcast. Let's get started. Hello, Deal Quest community. This is Kupfer, and this is a solo cast of the Deal Quest podcast this week. And the topic I want to talk about is something that just interestingly, I've had some inquiries on over the last couple of weeks, and it's on roll-ups. Basically the concept of somebody coming into a particular space and industry and buying up a lot of companies for the purposes of consolidating them. I've been involved over the years in roll-ups of various types, from helping to design some aggregator platforms in various spaces to representing companies who were acquired by aggregators. And there's some interesting, times. Back in the 80s, for example, they were very popular, and then that became a big negative connotation on the roll-up game because so many of the firms that went into roll-ups, there were some that were very, very successful. But a number of the firms that were roll-ups back then ended up not panning out. And so for a while, the concept was, somewhat maligned, actually, although roll-ups continued in various industries and some were very successful. And, they've sort of, come back, and they've never really left. But, as deals have gotten hotter again, I've just been posting lately around how this is probably the hottest deal market I've seen since the 80s. Roll-ups have certainly increased along with just the deal flow, and also the fact that we've talked about on this podcast, over not only recently but over the last couple of years, how much money there is in space, which also helps facilitate the roll-up game, the aggregator game. So let's talk about why people do roll-ups and the ones that work and don't work, and whether it's from the roll-up side or from the seller side. If you're approached by a roll-up to buy your company, is it a good deal? Is it not a good deal? Should you do it, et cetera? Let's look at the business model, the concept of a roll-up. Like, why do folks come in and do roll-ups? Well, there's a number of reasons. One, there's at a very basic level, the concept of how multiples go up as companies get bigger, right? So there are some players that say, hey, we're going to go out, we're going to buy a bunch of companies in an industry. We're going to buy them at X multiple, right? X EBITDA multiple, this kind of cash flow analysis, multiple revenue, whatever you want to look at as the measure. And because we're going to put all these companies together, just solely based upon the size increase, we're going to be able to get a higher multiple. And that's generally true in most industries. The bigger you are, the higher multiple you get. And of course, the base on which that multiple is applied is higher as well. So if you've got a bunch of companies out there that have $1 million in revenue, and, in theory, you aggregate 10 or 15 of those, and now you have 10 or 15 $1 million in revenue, or it could be 10 times that, right? You're rolling up $10 million companies and you buy 10 or 15 of those and you get 100, 150 million, or even into the billions, depending upon what size you're talking about. But in any case, at some point, you're going to hit that next step up where your multiple, let's say, and I'm making this up, it's obviously different by industry, whatever, but let's say your $1 million company, $10 million, whatever it is trading at a 5x EBITDA multiple. Well, maybe you can get, an 8 or 9 or a 10 even, as you grow. So there's just the multiple arbitrage in terms of the size of the company. And, that's often what people are depending upon. And frankly, if it's that alone, I think there's reasons to look at the roll-up and say, hey, what else is being brought to the table? Because when you do that, a lot of times it's market dependent, right? A lot of times these roll-ups are coming in at a time where multiples are going up. So the arbitrage is really a good play. But then, the market could drop. And And that's happened. Sometimes it happened back in the 80s, and some of these roll-ups got caught up where they could not exit at the higher multiples. So that's a risk. But what else do they bring to the table? So the next natural, easy thing that any kind of roll-up will talk about, and it's true, and it's often something that's talked about with any kind of merger or acquisition deal, is the economies of scale, is the synergies, is the fact that you can reduce overall costs, especially with back and middle office and admin stuff and logistics. You could potentially reduce personnel. You can combine systems. You can create efficiencies of scale. And certainly if you're, and that's true in any deal, but certainly if you're a roll-up and you've done it successfully, then you've also built, you're not just the best ones and not just taking a bunch of companies all, let's say all over the country and just owning them and keeping their expense structures in place, the management structures in place, but they're also creating some economies of scale. They're creating some centralized systems, accounting, tech stack, back office, things like that create efficiencies and create cost savings and create efficiencies that allow a more consistent delivery of service or products, or more speed to market, things like that. So now what you're doing is, right, you've got the multiple bump up because of size, but now you've also been able to make things more efficient, which makes companies more profitable. And then if you're more profitable, your EBITDA is higher, and therefore that higher multiple is applied based upon a higher profit. So for example, if these $1 million, $10 million companies are, run at 20% profit margins, and you can get the whole group running at a 30% profit margin because you've created some economies of scale and some efficiencies in systems and centralized management, well, now you got 10% more profit. And whatever multiple you're getting, in my example, you bumped up from a 5 to an 8 or a 9. You're not only getting that 8 or 9 on the previous EBITDA number, but you're getting that extra 10% profit, which raises the EBITDA that multiple is applied on. So you get additional valuation there. So let's go beyond that, right? Let's talk about where I have seen these roll-ups work better than others, and that is where some of those roll-ups are bringing even more to the table. Now, what does that mean? They may be bringing some more professional management. So there's like a difference between just the economies of scale and creating some back and middle office, and then maybe taking an industry where there is less professional management, where it's more scattered, where it's more mom and pop. And when I say mom and pop, I'm not necessarily talking about, like the tiny, store on the corner, because usually those aren't ripe for a roll-up, or, but, it's an industry. I'll give you an example. Back in the 90s, probably, I was involved with a roll-up in the ophthalmology industry. And this is before there were big ophthalmology chains, doing, and it was ophthalmology and optometrist, right? So a lot of these where they were the eye doctors, but also many of them they would sell sunglasses, right, as part of their practice. Well, this roll-up came in, created some efficiencies of scale in terms of billing and systems and that kind of stuff for the ophthalmologist, but also had a lot of expertise more on the product side, right? And, there's obviously ophthalmologists, are people who meet with patients and do eye exams and things like that. There's limited scalability of that because that takes people's time. Yeah, I mean, you could do what like I do as a lawyer, right? Which is hire other lawyers and pay them X and bill them out at X times. But obviously in a product business where, you can sell glasses and contact lenses and things like that, there's more scalability. And that's where this one of the things this roll-up brought was not only the product and distribution systems and whatever, but also bringing in systems and whatever to be able to have the ophthalmologist, sell patients on not going somewhere else to get their glasses, but actually getting their prescription, their diagnosis, their prescription, et cetera. And then also buying the glasses and contact lenses from the ophthalmology practices themselves, right? And they took what was, especially back then in the early 90s, if I'm remembering the time frame correctly, of a very, very fragmented, and there's still some fragmentation there, but now you see bigger change and things like that you didn't have. What was a very fragmented industry that had, decent profit margins already, where they saw that opportunity to not only have the multiple bump by size, not only have the economies of scale in terms of back and middle office and, technology and systems, for booking appointments and for things like that. And also, there's also knowledge on pricing and things like that. but also was able to create significantly more product sales in terms of the glasses and contact lenses for these various firms. So that's just an example of where there's something else that was brought to the table that increased revenue profit significantly on a per unit basis beyond just the aggregation for size and for economies of scale and cost savings. Now, what is the key from the roll-up side? Most of these roll-ups, I mean, listen, in theory, you could have a roll-up that buys a bunch of places and just going to create those economies of scale to create more cash flow and then just sit and own the businesses forever. And it's a cash flow play. I'm not saying that doesn't exist, but the far majority of roll-ups are really set up to exit at some point. And they may be set up to exit through IPO, public offering, or through acquisition. For example, especially if there is a major player or players in the space already, you might have, for example, a regional roll-up that is looking to sell to one of the national chains, right? They're going to do a roll-up in the geographic area where they know the space and the market, et cetera, create enough economies of scale because maybe that's too distributed, too small for the big guys to go after. But once it's rolled up and consolidated to some extent, it becomes attractive to the big boys. Or you might have a situation where there's no national major player, but private equity and things like that might, get involved to continue that roll up. And by the way, some of these roll ups are started by private equity in the first place. And then, eventually they'll sell out to somebody else or go public very often. Now, some of the reasons why things fail from the roll up side, from the aggregator side, is, like I said earlier, there could be a market drop. So the multiple arbitrage that they're betting on does not come to fruition. And they have capital that's deployed and they may, if it's private equity capital, for example, they're looking for a 3, 5, 7 year, out and returns. And now the market's down and they can't really exit. So that can become a problem. The ability to professionally manage and aggregate, reduce costs and create systems. If they fail at that can be a problem. Cultural fit, obviously, one of the things that happens in these roll-ups often is that there is some sort of centralized management and the individual owners of these firms lose control. Now, in some industries, that's fine. I mean, we did one, this was from the sell side, I was going to say a few years ago, it's probably 5, 6 years ago now, in the backup industry, where one of our clients is an online, computer backup provider and some related services. And there was a roll up in that industry who was buying, and the deal was structured where our client sold and was out pretty quickly and got paid pretty quickly. So the seller didn't take much risk there, and because it was tech based, it was easier to transfer. Whereas, for example, in my ophthalmology practice, you need people, you need doctors, right? You need eye doctors who are going to do that. And if they're not happy with the cultural fit, with the level of, because many of them are going to stay on, right, and continue to practice. And now, they've gone from being entrepreneurs to being employees. Maybe they have, and now we're starting to get into the structure a little bit. Maybe as part of that comp, they've gotten, in addition to cash, some equity in the roll up, and that's often part of the structure. I'll talk about that a little more in a second. So they're, maybe they're initially excited about that, and maybe the roll-up's not going as well. The market has changed, and the value of that equity is less exciting. Or maybe they're, they've lost management control, and they realize they don't like not being able to make decisions. All of these things come up. From the point of view of a seller, the decision of whether to sell to a roll-up, to an aggregated firm, versus not selling at all, or versus selling or merging with an individual buyer, it's always an interesting one. I will tell you that it's very often that roll-ups are paying higher numbers because, let's say, for example, for a buyer, so you're in a particular industry and a buyer, as many, I do a lot in financial services. So let's use, for example, an investment advisory firm. Well, let's say another investment advisory firm, would pay, and again, I'm just making up numbers, let's say would pay a 6 times EBITDA multiple, for your firm, because, that's what it's worth to them. And they're looking at integrating into their model. And it's only going to be so much savings and that kind of stuff. The aggregator may say, well, I can pay an 8 instead of a 6, or a 9 instead of a 6, because I know when I aggregate, I'm going to exit a 12 or a 14 because of all the things we previously talked about, the economies of scale, the size, the additional revenue and profit maybe they can generate through their expertise, the better management, et cetera. So I've seen many scenarios where I've represented sellers who have gotten what for them is above market multiples and often quicker and more favorable payment terms. I mean, we've done deals recently where people have been fully paid out actually over the last number of years, within a year or two. One was 10 months. And you're unlikely to get those terms from an individual buyer. Usually there's going to be more clawbacks. There's going to be more time to pay, a third or half or whatever the purchase price over a number of years, just because there's less access to capital, or there's more risk aversion to want to make sure that there are no problems, and they need more time for adjustments to purchase price. Whereas the roll-ups are often willing to take more risk, because again, their bet is that if they acquire quickly and aggregate up, they're going to get these higher multiples. So that cushions the downside risk, and speed really makes more of a difference, because when you're rolling up, you want to roll up quickly, because there may be other roll-ups in the space competing, or if they see your success, they may come into the space, which will create more competition, which will drive up prices. So a lot of roll-ups are looking to be quick to market and do a lot of deals quickly, and they're often, well-funded enough to do that. And again, they're betting on that multiple arbitrage, so they'll pay what is currently for your firm above market price. So if you are looking to exit, and especially if you're somebody who's getting out of the business, maybe you'll obviously stay on for some sort of consulting period, or even maybe a year or so in terms of employment. But again, with some of these aggregators, they have management in place depending on the industry, and you may not even need to do that. Whereas an individual deal, likely you would. You may be able to get higher multiples and take more money off the table. And, for many people, that's important. And especially if they think their clients will be integrated and well served. Now, which leads to the reason why some people don't like the aggregated deals, because they sometimes have concerns about whether their customers and clients, depending upon what kind of business they're in, will get the same kind of service, where it won't be as customized, where it will be more cookie cutter, where, maybe they're used to that personal touch, and will they get it? And that concern about having the clients or customers being taken care of sometimes is an impediment in those situations. Also, the fact that they are going to have little to no, say in management and control could be an impediment to somebody doing an aggregated deal. But, it's industry by industry, it's circumstance by circumstance, company by company. But certainly there's usually more money to be able to be taken, as I said earlier, potentially in some of the models, to get a piece of equity in the aggregator at the aggregator level. So if they are successful, you get sort of the second bite, of the apple. And I've had clients who've done that. They sold their company for a nice multiple. They've taken, let's say, 90% of it or 95% of it in cash, or 80 or whatever the number is, and some percentage of it they get an equity in the aggregator company, and the aggregator company eventually sells or goes public, or has whatever kind of exit they have. And so they the seller, my client in some of these cases, gets paid twice, right? They get paid a chunk of money in cash up front, and then they get this back end piece when the aggregator exits at that much higher multiple, because they've traded equity at their multiple. But then the equity of the aggregator is going to sell at a higher multiple.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment, and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
Where are we seeing aggregation right now? I mean, certainly, again, in financial services, there's a lot of it going on. There's many aggregators, roll-ups in that space. Certainly in some of the tech spaces. I know I've talked recently with some folks who are thinking about, who are looking at some industries. I won't say what they are out of respect for them identifying these opportunities and not creating competition for them. But, where they've become familiar with an industry and they see that it's fragmented, and that's where there's the opportunity, right? If you're in a particular industry, and it's tough, frankly, unless you're a private equity firm that can hire great management and has a huge amount of money. If you are more of an entrepreneur and operator, odds are any kind of roll-up opportunity for you to be an aggregator as opposed to being a seller is much more likely to be in your industry, just because that's what you know. You see the inefficiencies, you see the opportunity there, you know the players. I'm not saying you can't just identify an industry that you don't have experience in because you're a good entrepreneur or manager, and because you can build the right team, hire some people who know the industry. That is not doable. But more often I see either private equity money coming in because they've identified a space and hiring the right people, or if it's more the entrepreneurs, they're doing it in the industry they know, and they're often in the business that they're in. And they see this opportunity because they figured out a way to do it better in their own company, right? And they could say, oh, wow, I can bring this, there's so many of my competitors out there who are less efficient, who are less profitable, who don't have the system we built, who deliver a service model differently than we do, and we're crushing them. Well, maybe it's better to, and especially if you do have a reputation of being very successful, then when you approach your competitors, right? No, listen, there's going to be a number of them that are not going to want to talk to you. They're going to be scared off. They're going to not want to reveal any of their insight, their information, because they think you can use it to your advantage. There's also going to be a percentage of them that are going to say, hey, these folks have figured something out, right? They're crushing us competitively. Well, instead of fighting them, why don't we join them, right? So, and what is most ripe is, as we said, is industries that are more fragmented, industries that are less efficient, industries maybe where there's technology or other systems that can be put into place to make things much, much more efficient, industries where there's a gap between the best and the rest. And, there could be significant opportunities out there in those industries to aggregate. And, we've designed some of those in various industries. And what we do when we design them is that we create, some of you may, I have a 10-tip video series on my website on kupferlaw.com. It's actually directed to RA firms in terms of M&A tuck-ins and advisor onboarding deals. But the truth is the principles apply to any industry. And I've been thinking about, I probably should do one that's more general. But, one of the things we talk about is, and this is just not necessarily specifically for roll-ups, but for any deal, one of the things we talk about there is, as a buyer, you're going to start out by identifying your why, and then who you're targeting, and then what the value proposition is. So some of the things we talked about in terms of why aggregators do what they do, will give you a hint as to what their why is, right? They want to grow, they want to exit, the value proposition that they're offering to folks, either the cash, the equity, the ability to grow, the later exit, the higher multiples, that kind of stuff. And then, it leads to building a model and then creating your deal structure under the model. Well, certainly when you're an aggregator, it's even more important. I preach this for everybody. It's even more important to build that model, because you're going to have then create a deal structure under that model. And that's the way you're going to do deals, right? You do not want to, have many variations. And you could have a couple of variations in there, but basically you're going to do deals a certain way, and you're going to bring people into a system, and you're going to aggregate them in, that way. And so that's some of the work that we do, with helping folks think through these whiteboarding sessions and design the aggregator model, the roll-up model, and then we create the template set of documents that they do, and then the deals become easier, right? And I'm not saying there's not some negotiation. Obviously, you got to do due diligence on every deal, but you're not redrafting, repreparing a set of deal documents every time. You're just customizing them to the particular deal, because you have the docs, the templates, the way that you do it under your model. And by the way, that raises a negative potentially for this on the sell side, because if you're selling to aggregators, they will tell you the documents are standard, no change can be made. That's often not the case. There's usually some flexibility at some negotiation you can make. And we've done that, certainly representing sellers in terms of getting changes to the documents, maybe getting some more legal protections. But it is more limited than if you're negotiating often a deal with a one-off buyer, right? Because they don't want to, the smart aggregator is not going to vary all that much from their model. So that could create some less flexibility in negotiation on the sell side, and that's something to keep in account too. So listen, like any other model, like any other business, there have been some very successful roll-ups. There's been failures. You have to do your due diligence if you're on the sell side as to what the model is, whether you're going to be happy with that model. You obviously want to do due diligence on the management. Can they pull off the roll-up? what are the odds? You want to look at where the market is, although obviously that's hard to predict. But there is, market risk, so you want to evaluate that because, again, the whole thing is betting upon the multiples staying strong and increasing multiples. And, and you want to figure out whether, have they done many deals before? Are you their 15th deal or their 80th deal? Or are you their first deal, the second deal? I will tell you, if you're their first deal or second deal, you have more leverage to negotiate better terms and to help actually shape, their documents. So I've been on that side where I know my client has leverage because it's their first deal, and we'll be able to negotiate much more aggressively on the deal terms and on the legal terms than we would if they're with the 28th deal, right? So, worth looking into, worth considering if you're a seller, again, because of the higher multiples you may get and the other benefits, the potential second bite at the apple upside down line if the model is to give you some equity as part of the deal. As somebody who might be thinking about whether they should become a roll-up, obviously, if you see those inefficiencies, you see those ways you can do it better, you've created systems that work, that's an opportunity. Keep in mind, one last thing I'll say, if you're on that side of the game, is that when you become a roll-up, you as the entrepreneur, you as the CEO, you as the management team are going to be playing a different role now, right? You're going to be doing a lot less of running the operations of whatever business that you have in that particular industry, but you are instead now going to be doing a lot of recruiting, right? A lot of selling, a lot of deal making to bring others in, while you have ops people doing that, right? We talk generally about how it takes time and energy and focus to get a deal done while you're operating a business as an entrepreneur or executive. Certainly, if you become a roll-up, your management team and or a specific newly hired team that you bring in to do that, who has experience of that, you're going to need people to focus on that. And your job as the CEO or executive overseeing that's going to change, materially. So you want to take that into account as well. Folks, check it out. Think about it. Rolling up is an opportunity. Selling to a roll-up is a potential opportunity. There are upsides and downsides. I've just seen an uptick in inquiries about this. I've spoken to a couple of people recently about who are looking potentially to roll up in the industry. And again, we've designed a number of those recently in financial services and tech, especially. That's been the recent stuff. But, like I said, we've done a bunch of industries, ophthalmology, as I mentioned back in the 90s and everything in between. Yeah, interesting opportunity, something to think about, especially when capital is available, because that's key. The roll-ups take funding and capital is available now. So think about it from that point of view. Getting a lot of inquiries on it. I don't know whether that'll mean that there'll be a lot more roll-up deals coming our way. We'll see. We've had some and some people kicking the tires. So have a great week, folks. Next week, back with a guest interview. And then, as always, we will be back in a few weeks with another solo cast. Thank you, DealQuest community.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.coreykupfer.com/dealden. That's coreykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.